Hi guys, it's Marissa Schultz here, author of The Rise High Investor. I bring you these weekly videos to help you on your property investment journey so that you can build wealth in property and achieve your financial dreams and goals. And today I'm talking to you about the risks of buying property off the plan. So let's just explain what that means first. To buy property off the plan means that you're signing a contract for the purchase of the property and paying a deposit up front, generally about 10% of the purchase price, and then that property will settle at a point in time in the future. Generally, there's a fairly long lead time, maybe 12 months, 18 months, 24 months, maybe even longer. So it basically means that you're buying the property up front before it's started construction, you're paying your deposit, and then you're going to settle on that property way down the track. Okay, so the reasons why people like to buy off the plan is because, they don't want to miss the boat. If there's a particular development going on and they really want a property in that development, then, buying off the plan is a way to secure that property for them in that development. There is also, an advantage if the value of the property increases and exceeds the property purchase price at the time of settlement. So let's say, for example, you buy a property and the purchase price is $400,000, and let's say that the market in that area, has a bit of a boom, and the value of that property is $420,000 at the time of settlement. You've instantly got $20,000 worth of equity. That sounds really appealing, right? But, and there's a big but, there is a very long time between the date that you sign the contract and the date of settlement. And there are lots of things that can go wrong in that time. So I just want to make sure that you're aware of the risks before you proceed down this path. Firstly, you may not realize that you're actually signing an unconditional purchase contract. Even if you have asked for a subject to finance clause, that clause is probably only likely to get you through maybe a 3-month window. At the end of that 3-month window, your contract officially becomes unconditional. And that means that if you can't proceed with settlement for some reason, you have a lot to lose. Let me explain. There's a few reasons why you may not be able to proceed with settlement, and some are in your control, some are outside of your control. But let's have a look at some of the reasons why you may not be able to proceed with settlement. Firstly, if your situation changes, it can reduce your borrowing capacity. So let's say, for example, something happens to your job. You lose your job, or if you're self-employed, you have a bad financial year, in the year that you need to settle. Or let's say something happens to your health, or something happens with your family situation, maybe, an unexpected pregnancy or an extra child, something like that. There are certain things that are outside of our control that can impact our borrowing capacity negatively. So just because you can borrow the money at the time you sign the contract doesn't mean you're going to be able to borrow the money at the time of settlement. So that's the first thing. Even if your personal situation hasn't changed, there is always the risk that interest rates will increase over that period of time. And if interest rates increase, that may actually deteriorate your borrowing capacity as well, as banks will assess your servicing on a higher interest rate. So that's the second thing. The third thing is that banks' lending policy can change at any time. So if the bank's lending policy changes, let's say, for example, the amount they're willing to lend on the property, the percentage, the LVR, or potentially just, how they assess your income or how they assess your servicing, if the bank's lending policy changes, that can impact your ability to be able to borrow the money when you need to borrow it, okay? The other big one here is that we talked about the advantage of buying off the plan and hoping for the value to be more than the purchase price at settlement, but you've got just as much chance of the valuation being less than purchase price at settlement. Now, if that happens, at the point in time that we come to settle, the bank will want to get a valuation before they proceed with the loan. If the valuation falls below the purchase price, guess what? You still need to pay the purchase price. And guess what else? The bank will only lend against the value of the valuation rather than the purchase price if the valuation is lower than the purchase price. What that means is you're going to have to fork out more money to make sure that that purchase can go through. Now, let's say we get to a point and we're close to settlement and you actually cannot proceed with settlement. You do not have the ability to get the loan to proceed with settlement. What are the consequences? Well, firstly, you're likely to lose your deposit, and that can be quite substantial. You know, if you pay $400,000 for a off the plan purchase, you might have put down a deposit of 40 grand. You know, that is a substantial sum of money to lose. But that's not where it stops. You know, if the developer really wants to stick to the letter of the law, generally most of them have clauses built into their contracts that they can actually get the loss from you as well. So let's say, for example, you've bought a property for $400,000. You cannot proceed with that purchase. You've paid a 40 grand deposit, and then they go to on-sell it. Let's say they can only sell it for $350,000. You might be up for the difference in what you were going to pay for it and what a new purchaser pays for it. And that can be quite substantial. So you really need to be very, very careful when you decide to enter off the plan purchase contracts, because there are significant risks involved. I really only recommend it for people that are in an exceptionally strong financial position with good cash reserves and good equity in other properties that they own. So if the valuation does come in short, or if their borrowing capacity is impacted, they do have the ability of getting the money or the equity from other areas to make the purchase go through. So that's my thoughts on buying off the plan. Make sure you be careful. And I do want to say thank you for tuning in. I really appreciate you tuning in and supporting me every week. And as a special thank you, you can actually grab a 50% discount off of the purchase price of the book. If you hop onto the website risehighinvestor.com.au and enter the code video, you will get your discount. You can also contact me at any time at propertyinvestor@risehigh.com.au, and I love hearing your questions and comments. Thanks again for tuning in. I will see you next week. Bye.